Questions are raised over the health of the UK retail sector as JD Sports shares tumble. Welcome to Market Insight. I'm Ludovica Brignola. Shares of British sports retailer JD Sports tumbled 14% today after it warned that its annual profits would come in at the lower end of its guidance following a difficult October and subdued consumer spending. The company has warned that discounting is likely to drag on profits as well. So how does the broader retail sector look like in the UK? Well, to help answer all that and more, I am joined by Russ Mould. He is AJ Bell's Investment Research Director. Thank you very much for being with us today. Russ, so JD Sports shares tumbled following, as the company said, a difficult October, subdued consumer spending, discounting. Now, what's the landscape? What's the outlook really for the company, first of all?
Yeah, it's interesting. The company actually blames the US more than it does the UK. And it says a lot of that weak October was down to uncertainty ahead of the US presidential election. I don't know whether people putting a vote in the ballot box will really affect what sort of sneakers they want to buy, if the truth be told. But I guess it does show how important America is to JD overall. I mean, the UK was, having said that, weaker than the United States in terms of like-for-likes, and the one strong point was Europe. I think it probably does reflect, UK consumer confidence has weakened. There are some signs of some stress in American consumers. You've had a Target profit warning very recently. For example, their shares collapsed this week. So there are some signs of selective stress in certain demographics in the retail sectors on both sides of the Atlantic.
That's quite interesting that a lot seems to be doing, with the US rather than the UK itself, because on the other hand, Next said annual profits may top £1 billion for the first time, thanks, I wonder, to a strong domestic customer base, perhaps, Russ?
I mean, retail also, in principle, is a relatively simple business. Right product at the right price, in the right format for your target demographic. Now, if it was that easy, everybody could do it. But Next is clearly getting it right at the moment. And it's doing that through its own branded product. It's doing it through third-party products, which it continues to add to its website, and it's doing it through both stores and through both its online presence, so and click and collect. So it's at the moment getting the formula absolutely right for its demographic, which is relatively affluent, not luxury goods level, but it attracts a very nice customer. It produces some very good products, not premium price, not bottom of the range, and that is a beautiful formula. Whether it quite gets that £1 billion or not, we'll see, but it's had that very happy knack over the last 2 years of constantly upgrading earnings forecasts.
That's interesting. It seems to be good news. And more broadly, what do you think is the state of the retail sector in the UK right now?
I mean, if you just looking at it from the stock market's perspective, it had a terrific run this year all the way through to September. And then once you started to see inflation proving a little bit stickier and worries over the government budget deficit gather, and maybe interest rates not come down as quickly as expected, it's lost some of that momentum. You've seen consumer confidence weaken according to the GfK consumer survey, and it'll be really interesting to see how that works out in the wake of the budget and some of the changes we've seen to the UK tax regime, for example. So it's had a fab run. It's definitely proving a little bit more difficult now for consumers. Again, I think it's very much selective. Next is still upgrading numbers. JD isn't. B&M European Value Retail isn't. Food retailers having to work really hard because of cost inflation and competition. So as ever, it's a horses for courses mixed picture.
Right, and since you just mentioned the budget, it's interesting because large UK retailers, including Tesco, Boots, Marks and Spencer, and also Next itself, they have written to Rachel Reeves to say that a £7 billion increase in annual cost after last month's budget would lead to job cuts and higher prices. And they were referring in particular to changes in national insurance, national living wage in the budget. Now, what do you make of that? And is it a worry for the broader economy?
I mean, it's tempting to look at the headline numbers. I mean, Tesco's makes around £2.5 billion a year. For example, Sainsbury's £1 billion. Amazon worldwide is forecast to make about £50 billion this year. So it's easy to think, well, actually, they can afford this really in a very straightforward fashion. But retail is a very labour-intensive business and generally quite a thin margin one. Tesco's works to a 3 to 4% operating margin, for example. So those percentage changes in tax are actually quite a big swing factor for them. So there is a balancing act there. The retailers aren't saying that they don't want to pay necessarily, but they want the changes to come in a more measured, slower fashion so they can manage minimum wage, national insurance and employer taxes, and also packaging and recycling costs, which are now being switched to them from local council. So they didn't say no, no. I think they get the message that we're all in this together and that saying no is a bad look, but they certainly are asking for a more measured approach. And there is a legitimate risk that it feeds into higher inflation and potentially less hiring going forwards.
That's really interesting. Russ Mould from AJ Bell, thank you very much for being with us today on the programme. And that is Market Insight. Don't forget, you can watch more videos on Reuters.com.